All righty, everybody. As I always start off by saying, give me a second. Make sure that we're streaming across all the various social media platforms. I am excited for this conversation because I have known Mr. Adam Johnson since 2011. I want to say
Long time.
back when he was doing the Bloomberg rounds, was always one of my favorite anchors, and the guy that always reminded me of Dan Aykroyd from Trading Places. And I know you know that reference quite well because I know I'm not the only one that said that. For those of you that are watching this on X, YouTube, LinkedIn, we can see your posts. Let's make this interactive. If you want to ask Adam a question, ask Will a question, type it in whatever platform you're on. We'll try and make this interesting in terms of going back and forth with those that are watching. I will give Adam Johnson a ton of credit because when I was in my peak bearish phase, he was the bull and was right when we did the spaces, I want to say a year and a half ago or so.
Yeah.
So with all that said, my name is Michael Gayed. This is the High Conviction Podcast by GraniteShares, and I am the publisher of the Lead Lag Reports. Joining us for roughly 50 minutes is Mr. Adam Johnson, and of course, my friend and co-host, Mr. Will Rhind. Will?
Mr. Guy, thank you very much for the intro. Adam, thank you so much for joining us today. My name is Will Rhind. I'm the founder and CEO of GraniteShares. We're an ETF company, and we're based in New York, issue a series of ETFs ranging from strategies such as gold and commodities through to leveraged single stocks on popular names such as NVIDIA, Tesla, etc. The business has been around for a number of years, and we're active in the US markets, in European, and in Asia.
And of course, Mr. Adam Johnson, who I don't know, do people call you a perma bull now at this point? Because you've been so right.
Well, thank you. I'm not right about everything. I was long Silicon Valley Bank shares, so I don't get them all right, but I get most of them right, and I get most of them right by finding great growth companies of all sorts of different market caps, companies where I can actually project or try to project out in the future and see significant earnings growth and therefore the possibility for significant stock appreciation. And Michael, if I can find a company that fits my American ingenuity paradigm, right? People, companies, and technologies driving the world forward. And again, I can find a pathway to profits and a pathway to a doubling, tripling, or quadrupling of the stock over the next couple of years. I write it up for my bullseyebrief.com subscribers. And for my money management clients, that particular stock find its way into the managed accounts, and I let them go. And my average holding period now is well above 2 years. That's the way I like it. I don't trade. I used to be a trader. I was an options trader for many years, and I found that the best use of my time was trying to find these exciting growth companies. And as I say, just letting them run. Occasionally, we have to cut back on the ones that don't work. Sometimes we cut the ones that are working on the way up. I mean, I bought NVIDIA a long time ago, and I've been selling it on the way up, and it's still a 6% position. So I think that's sound risk management.
Wow.
Yeah, that's what I try to do.
It's a nice place to be in if you've been selling NVIDIA all the way up and it's still 6% of your portfolio.
Yeah, well, I had a mentor, Will, years ago, who told me that you're only rational once, and it's before you buy the stock. So set the target in advance, and if the stock gets there, sell some of it, whether that's a quarter, a third, maybe even a half, if your target was a double or a triple. And so yeah, I bought NVIDIA. It's really not that long ago, 2.5 years ago, and on a pre-split adjusted basis, it was down around 100, and had a couple of targets on its way to 1,200. And I sold in each case. Then the stock split 10 for 1 and now trades around 120, 125. And, my next target is up around 150. It'll probably get there. We'll sell a little more. I'll rerun the numbers and we'll see what I come up with at that point.
Great. Well, maybe that's a good place to start in that I'm sure we'll get into a number of these themes, including AI. I definitely want to talk to you about that. But maybe just let's start sort of big picture, in terms of your thoughts on where we are, economy, macro, at this point in time.
Yeah, I think there's a lot more to like than to fear. And that's why I've been fully invested for quite some time. And let's drill into that. And I'll tell you how I get there. GDP is growing somewhere around 3%. that's a strong tailwind right there. Earnings are rising. I think actually the third quarter we may see only high single digits. But if you look forward out into the fourth quarter and then the first and second quarter of next year, I'm pretty comfortable with 11, 12, maybe 13% growth year over year for S&P 500 earnings. That's powerful. We also have inflation that has come way down. You know, if you average all the four indicators, consumer prices, CPI, PPI, the GDP price index, and personal consumption expenditures, if you average all four of those together, you get to an inflation rate of somewhere around 2.3% versus a 2% target for the Fed. You know, CPI was 9, PPI was 11, so we've come way down. That's good. That's another tailwind. Employment, I know that's got some people concerned, but look at the report we got last month. We're still creating, you know, 150 to, in some cases, some months, 200,000 jobs a month. So there's a lot more to like than to dislike. I know elections are uncertain, but we always work our way through that. I know that there are geopolitics out there. That's not really a market story. So again, yeah, I think this is a time you want to be long, and we can get into the presidential cycle and the candidates and possible outcomes. But yeah, there's a lot more to like than to fear.
Are there any sort of risks in your mind? I mean, maybe leaving the election aside for the moment, because you know, clearly, as you just rightly pointed out, that there are a lot of things to like, and certainly don't seem to be that many. But are there any risks that people should be thinking about?
I think the single biggest risk, potential risk, is that inflation reaccelerates. I don't expect that to happen, but if it did, we'd have a real problem, because I think a lot of the gains that we've seen are predicated on inflation returning back to normalized sort of 2% levels. The Fed cutting rates, which is a tailwind for stocks, not just because companies need to go out and borrow. You know, young companies, all those young little Russell 2000 companies constantly need to raise capital, and lower rates makes their cost of borrowing lower. But the other thing that's a little more subtle and yet probably more meaningful is that when rates come down, your discount rate for what future earnings are worth also goes down. And that means you're able to pay more for stocks today based upon what you think earnings will be tomorrow. And I think that lower discount rate is ultimately the most powerful impact that percolates through stock prices and can justify higher stocks. So yeah, the number one risk in my mind would be that inflation reverses and goes back up, and all of a sudden the Fed is on hold. That would be an issue.
So at the moment, your assumption would be that the Fed is going to engineer a soft landing, and sort of, I guess, within that, not to put words in your mouth, but how do you sort of see the next sort of 12 months or so from an interest rate perspective?
I think the Fed already has engineered a soft landing. And I know that one of the favorite things on Wall Street, people's favorite pastimes, is criticize the Fed. Everyone needs a punching bag, and whether your punching bag is China or the Fed, there's always something, and people need a villain. Just look at the political climate. Each side needs a villain, and so the Fed's a common villain, but I don't think they deserve to be a common villain. They waited too long to raise rates, but I think they've done a reasonably good job at letting inflation come down and not jumping the gun, and actually being fairly responsible. So I'm going to give the Fed a lot of credit. I do think that the whole guidance thing has gotten way out of hand. I think that the Fed spoon feeding all of us the same way that CEOs and CFOs spoon feed all of us 12 weeks at a time, the earnings game. I think that's just gotten silly. I think we all got spoiled as kids in sixth grade, where everyone who ran the 40-yard dash got a blue ribbon. I mean, when we were growing up, you basically only gave a blue ribbon to the winner, and everyone else got a sort of attaboy and a pat on the back and said, better luck next time. And now we've just gotten so accustomed to guiding every single metric. So I wish we weren't doing that. I wish the Fed weren't quite so specific. I wish they were a little mystery. But I think the Fed's done a reasonably good job to this point.
And do you think, or what is your view in terms of where we are in terms of interest rates? Do you think it's, another couple of cuts before the end of the year, maybe more into next year? And are we sort of, you can market consensus or somewhere above or below that in terms of the neutral rate?
Well, I think the market got a little ahead of itself, which is why the 10-year is back to 4%. It got as low as almost 3.5%. And, it's just amazing. The pendulum always swings too far to one side. There are very few things in life or on Wall Street that are predictable, but pendulum swinging is definitely one of them. So, the Fed cut rates by 50 basis points. People said, oh my gosh, they're going to be really aggressive. They'll cut another 50 in November, another 50 in December. Oh, and next year, they'll cut a full percentage point. I think that's a little aggressive. I think it's too aggressive. And I think the market's realizing that, in part based on comments from Mr. Powell himself a week and a half ago, and then the jobs number from a week ago, where all of a sudden you realize, this economy's not in trouble. There's no recession that's happening. The Fed doesn't drastically need to cut rates, but they are going to lower rates, which is appropriate. I mean, they took rates up to 5.5% because inflation went to somewhere between 9 and 11, depending upon how you want to measure it. So it would only make sense that inflation comes back down into the twos. They would take some of those hikes back. That's what they're doing. So maybe it's 25 bips in November, 25 in December, and going out next year, call it another 50 bips. So that's a total of 1% from where they are now, which means that Fed funds go from the current 5% rate to a 4% rate. And then there's probably a little bit of other movement down from there. So the 10-year probably ought to be 3.5 to 4%. Mortgage rates probably ought to be 250 basis points above that. So that gets you 7%, maybe into the high sixes. And all that's good. But, rates aren't going back to where they were because they don't need to. We're not in COVID anymore. We're not in the great financial crisis anymore. So, if you're waiting to buy a home because you think a mortgage rate is going to be available at 3% again, it's not going to be. That's the cheapest money that any of us will probably ever see in our lifetimes. But it also means that it's keeping housing prices high because anyone who locked in a super low mortgage, and 80% of the country now has a mortgage below 4%. People don't want to sell. They don't want to give up that cheap money, and nor should they. So that's the one caveat. If you think that housing prices are going to come down a lot, they're probably not, just because the housing supply is going to stay a little tight. And that might mean that people who are hoping rate cuts will actually make a big difference for them, or at least if they're trying to buy a home, will probably be disappointed. The rest of us will be fine. Rates will come down in general. Inflation's coming down. If you want to finance a car, fine. But if you're looking to buy a house, it's still going to be expensive, is my guess.
Yeah, I think probably more supply coming onto the market, but doesn't necessarily mean a fall in prices. It's just there's more inventory available.
Yep.
Hey, Adam, does the path of rates matter for large cap tech at all? I mean,
no.
They're all cash rich anyway.
No, and that's a very apropos question, Michael. And I tell you why I say so. And I don't mean to be sort of off the cuff about it. But what matters most for certainly the companies I buy. Remember, I run the American Ingenuity Fund. I'm a growth investor. What matters most is growth. It's not cheap money. It's not cheaper money. I mean, that helps. It helps at the margin, and it certainly helps the small cap companies. But you asked about large cap tech, and no, I don't think that cheaper rates really means any difference at all for a Meta or for a Google or a Microsoft. I mean, some of those valuations, Microsoft at 35 times earnings, it's not exactly cheap, but it is growing pretty consistently, 15 to 20%. They own half of OpenAI, which, created ChatGPT. That we've just learned from the latest financing round is worth what is it? What's the number? I don't even want to say it. It's worth a big number. Some of the valuations are getting up there, but as long as you have the growth, I think that's what matters more.
Yeah, I think it's always, people at the end of the day, it always comes back to they'll pay a premium for growth. It's just only a question of what that premium is. But as we've seen with large tech companies, that they've been able to grow and make money in times when interest rates were low, and also when interest rates were high. And almost that was the kind of the better example, was that these companies continued to push forward even with interest rates of 5%. It really made very little difference, if any.
Yeah, that's right. I mean, just remember Meta. What a crazy ride that was when Mark Zuckerberg wanted to explore the metaverse, whatever that is. And I was long it. I was buying it at 150, and it went down to 82. And I remember some of my clients calling me, both the newsletter subscribers as well as the money management clients. I said, why are you buying more Meta at 82? I said, because at 82, it's trading at 15 times earnings, but they're spending 16 billion on the metaverse. If they just stop spending that money, earnings will more than double, and all of a sudden it's trading at 7 or 8 times earnings. And I said, I think Zuckerberg's getting religion, and that's what he's going to do. And sure enough, within literally, 7 or 8 weeks, he said, I'm over the metaverse. It's been an adventure, and it's not one we're going to pursue any longer. And we're going to basically cut our CapEx on the metaverse. And sure enough, all of a sudden, everyone reran the numbers and said, "Oh my gosh, this thing is trading at a single digit PE." It went from 82 to 150 very quickly to 250 to 3. Now it's 550. My new target is 625, and I'm very comfortable with that. And that was a story about growth and capital allocation. It had nothing to do with interest rates.
Yeah, I think the only thing that I think people could take away from that environment is that it is about, or can be about, the capital discipline.
Yeah.
And clearly in a lower interest rate environment, then you have much more flexibility to go out and hire like crazy, to spend massive amount, borrow and spend a massive amount of money on R&D, things like that, which you can maybe get away with more in an environment like that, as opposed to where you have a higher interest rate environment and investors are calling for a bit more discipline. But apart from that, the business model, is still the same, and be rewarded regardless of interest rate environment.
Yeah, yeah, and as I say, I've done very well for clients, but I don't get them all right. And to your point, every clean energy stock that I bought, starting about 2.5, 3 years ago, it was a total disaster. The reason being that those companies weren't growing. We thought maybe they would grow based upon the promise of the Green New Deal. But interest rates were practically zero. Money was not free, but pretty darn close to it. And they were surviving on government subsidies. And when rates went up, all of a sudden their borrowing costs shot through the roof. And then the government realized it couldn't afford to subsidize these companies indefinitely. And all those clean energy stocks, you name it, from ChargePoint to Sonova, it was a disaster. And, I had to cut them. I was down 40, 50%, and I cut them. I was, by contrast, I mentioned Meta and a handful of other of the big guys that I was very comfortable buying because it was a very different story. They were growing. Clean energy was the promise of growth, and that was dependent upon cheap money and subsidies. That doesn't work in a rising rate environment. So, we come back to our same point. Growth is ultimately what's most important. And remember for next time, because there'll be somewhere out there in the future, Mike will be able to put on his bear hat again, and he'll be right. And, markets will go down. And the lesson that we all need to remember from the past couple of years is focus on high quality companies, strong balance sheets, low leverage, strong income statements with lots of cash flow, differentiated business models where companies have pricing power and unique products that everybody wants, like NVIDIA chips, right? So all those lessons that we've learned will become very important. They'll become paramount again. Fortunately, I don't think anytime soon will we see a recession, but there'll be a point at which we're going to have to roll out that playbook, and we're going to have to cut out the speculative stuff and go way up on the quality curve, as we had to do, 18 to 24 months ago.
Does the election matter in any of this? Clearly for one side or the other, like what's the sort of prognosis on which candidate's better for the stock market?
So I think you have to consider conventional wisdom on one hand and unconventional wisdom on the other. Conventional wisdom would hold that Mr. Trump would be better for markets because he wants to cut taxes, he wants to lower regulation, and he wants to drill baby drill, which means cheaper oil for all of us, and that's deflationary. Fine. So Trump, better for the markets, conventional wisdom. And then there's unconventional wisdom. And by that, I mean, the Harris plan is to lift up the middle class. And they haven't been entirely clear on how they do that, but suffice to say, it'll be new incentives. They keep talking about a $25,000 grant, in effect, or credit, or something that would help first-time home buyers. They talk about lowering taxes for lower and middle-income families, raising them for higher income families. But I think a Harris White House is going to be stimulative. Well, markets generally like a stimulative White House. Now, if Harris wins and Republicans, meanwhile, keep the House, that might actually be the best scenario for markets, because you have a stimulative White House that is held in check by a Republican House. Remember, tax and spending always start in the House, so they would keep her in check. And in fact, if you look historically since World War II at the combination that is best for the market, it's a Democrat in the White House, it's Republicans in the House, and it's Democrats in the Senate. And that combination is what we've had for the past 4 years. And the past 4 years, ex the COVID craziness and rate hikes, has worked out pretty well. And that combination that we talk about, again, Democrat in the White House, Republicans in the House, Democrats in the Senate, that combination has produced an average return of 14.9% since World War II. So the unconventional wisdom is that you might actually want to see Harris in the White House, and as I say, Republicans keep the House. Senate could almost go either way.
One more sort of macro question, and then I want to talk about your investing philosophy. But China's been hitting the news over the last couple of weeks, finally for all the right reasons, in terms of the stock market going in the right direction for investors there.
Yeah.
Is this the sort of the start of the comeback, or another sort of false dawn?
For China?
Yes.
I won't touch it, And I mean, if I had touched it just 10 days ago, I think I'd be up 23 or 24% as of today. But you have to know what you're good at, and American ingenuity is my thing. I focus on this country. I know there's ingenuity elsewhere. I know there's opportunity elsewhere, but I like to focus on what happens in this country. The thing about China is they constantly move the goalposts. And the whole reason that China has reinflated over the past couple of weeks is because they move the goalposts. They basically drop the reserve requirements for the banks, and they're adding stimulus. Now, we do that sort of thing in this country too, but not to the extent that the Chinese do it. So you never really know what you're getting in China. And if you look at the Chinese market over the past 4 years, it hasn't been straight down. But, if you were to look at it, because, it gets these little bounces, a few weeks or even a month or two at a time. But, quarter over quarter over quarter, it's been a painful ride. If you just pull up a chart of the China ETF FXI, you'll see what I mean. And suddenly we get this bounce on a news headline because the Chinese raised the goalposts. They said, or they moved the goalposts. They reduced the reserve requirements. So I'm not comfortable investing in a place where I don't know the rules, and the rules can be changed at any given day. One of the things that I love and respect about this country, and I think has been key to our success as a nation, is that we have a stable accounting system and we have a stable legal system with checks and balances and integrity. Government doesn't always get it right. It's like Winston Churchill says, the thing about America is they get it right after they've tried everything else. So I'm comfortable investing here, deploying risk capital here. I'm not comfortable deploying risk capital in China. I have no positions in China. I probably never will, because I will always focus on American ingenuity right here at home.
Fair enough. You can tell we're having a classic New York conversation there with all sirens in the background.
Yep.
So let's talk about American ingenuity. Can you just explain a little bit, more, I guess, expand on what you've been saying? What does that mean to you? What kind of stocks do you own? Kind of themes are you most interested in at the moment?
Sure. Well, I've said it before, and I'll say it again just to hammer it home. For me, I define American ingenuity as the people, companies, and technologies driving the world forward. Now, if you say, okay, what does that mean? Well, I look for a couple things in every stock, and just about every position in the portfolio shares some common attributes. First of all, there's a great story. We've talked about NVIDIA. That's a great story. Fastest chips in the world. At the far extreme, Joby Aviation, creating these air drone taxis that will ultimately transport people from city centers to LaGuardia, Kennedy. They're going to be up and running in Dubai next year. That's a great story. There has to be data. That's point number one, a great story. Point number two, there has to be data that supports the thesis. In the case of NVIDIA, chips that are, capable of 60 to 70 trillion calculations per second. No one else even comes close. Earnings that are growing 70, 80, 90% still. People say, oh, well, they were growing 400. Well, that's not sustainable. It never is. But I think as you look out at NVIDIA, you can see 75 to 80% growth over the next couple of years, which means that a stock trading at 30 to 35 times forward earnings is actually pretty cheap, given that growth rate. There has to be data that supports the thesis. And then there has to be some sort of newsy hook or a catalyst or something we're all already talking about. NVIDIA speaks for itself. In the case of Joby that I just mentioned, that's something that we're all talking about
I think Adam's connection froze there. Give us a second, folks.
Yep.
Let me shoot Mr. Johnson a message. The joys of being live. This is why we're going to edit this out afterwards. I do like that point about you need a good story, though.
Yeah. Well, we're getting to a good part of that with the Joby Aviation comments.
Which I'm not familiar with that company, actually, but sounds like you might be.
Yeah, they're in the eVTOL space. So part of the, flying cars, if you want to oversimplify type movement, but, robo-taxis for the air.
So I got to get comfortable not just with robo-taxis, but flying in them, is what you're saying.
That's right. Yeah. They're I've heard less about them recently, but we should ask Adam about this. But it was one of the huge kind of companies that people were betting on at the height of 2021 before everything got repriced. But again, these big bets on the future of aviation, electric, vehicles that can take off vertically, land, the revolution, I suppose, in urban airspace and mobility. They're one of a few companies kind of battling in that space.
That's more of a mid-cap company, or what's the size of that?
Good question. I would imagine it's probably come down a lot since the height. But yeah, let's have a look.
And folks, if you have any questions as we wait for Adam Johnson, just type it in whatever platform you're watching this on. We could see it. Doesn't matter if it's X, YouTube, LinkedIn. Always happy to kind of riff on things. I think
4 billion.
Adam, 4 billion, yeah, more on the mid-cap side. It would be there we go. There's Adam.
Did we lose one another?
You are back, my friend. Here you go. So you were talking about the aviation company.
Oh, yeah. Gosh.
Joby.
Yeah. Well, I guess we lost the internet, but you missed my wonderful soliloquy on Joby and everything else that we're talking about. Well, yeah, Joby's such an exciting company. They're going to be up and running, carrying people from city centers to airports in Dubai as of next year. But, that's the Uber of the skies. That's the way I think about it. That's a powerful concept. So a great story, data that supports the thesis, and some sort of newsy hook or catalyst. Those are the three things that all of my bullseye picks share in common.
Now, there's a question actually about Tesla. So given that we're rapidly coming up on the robo-taxi day here in October, do you own Tesla? And any thoughts on the company?
I've never owned Tesla, and I tell you why. If Elon Musk can convince me through deed rather than through thoughts or words that it's more than just an EV company, I could see buying Tesla. At this point, Tesla is still an EV company. 95% of the revenues at Tesla come from just selling cars. Only 5% come from selling batteries. If he could build out the battery business, and I don't mean just building out car batteries, I mean building out the big industrial batteries that help utilities store energy or that help houses store energy. They've got this battery. It's an amazing thing to actually see installed in a garage. It looks like a mattress that's sort of flipped up on its end and it just hugs the wall. It's only about 8 to 10 inches deep And literally, otherwise, the dimensions are the size of a mattress, just sitting there on the wall, and it's able to store power. So whether you want to pull power off the grid at off hours when power is cheaper and store it, and then you can draw on it when electricity gets more expensive, or if you have solar panels and you want to store power that way, that's pretty innovative, pretty exciting. I could get excited about a Tesla power company. Robotaxis, I don't know about robotaxis, but I do think, and we're already seeing them through another one of my holdings, a company called Symbotic, SYM, which is turning all the Walmart warehouses into robotic warehouses. We already see robotic forklifts. So I think there is a place for robotic mobility. I'm not sure it's necessarily or auto. I don't know if robotic is the right word, but cars that drive themselves. I think of that as a robot, for lack of a better word. Autonomous driving is really robotic. I'm not sure I trust robotic cars, certainly in New York City, where people, walk across the street anywhere they so choose. But, in a controlled environment like in a warehouse or maybe even an airport where airplanes are moving in very specific patterns on the ground as they taxi to gates, might there be, a place for robotized transportation of luggage, baggage, and all that? Yeah, I could see that. So there's a place for it. I just don't think it's ready for out there here on the Upper East Side in New York City.
Do you think it's coming soon though, or you think it's sort of one of these ideas that is probably going to be further away than we imagine?
Yeah, it's further away than we imagined, and I think further away than we still imagine. It'll happen. I mean, it might be. Let's just have some fun with this. What's another controlled environment? Trains. I mean, it might be that Burlington Northern Santa Fe freight trains or Union Pacific freight trains will start to be driven autonomously or even remotely. I could see that. That makes sense to me. But or even commuter trains potentially. I mean, look, if you go to the airport, and you're at O'Hare and you need to get out to the far gates, you're taking a train that's effectively driven autonomously. So it's not like I'm saying something that's really that much of a reach. But that's very different from cars driving around pedestrians on busy streets.
Yeah, no, certainly it's different.
Yeah. And as I say, I'm along this company Symbotic, ticker SYM, that went from 8 up to into the 60s. And per what I said earlier, I had a $55 target, so we sold a chunk of it. It's come back down into the 20s because they had to sort of postpone their growth rate. They had hired an outside company to basically subcontract some of the building out or converting of the Walmart 47 distribution facilities because, if they hired another company to help them do it, then they could go twice as fast. Well, that other company wasn't as efficient because it's not Symbotic. So they basically had to they had to take that back in-house, and that's why they guided down, and the stock went from 45 to 25. Fine, it's part of a high growth company that had to reset. Very happy owning the shares here, and have added to that position for some of my newer money management clients. And again, they're focused on making warehouses, robotic warehouses. GXO, which was spun out of XPO, one of the largest less than truckload operations in this country, founded by Brad Jacobs, by the way, who also founded URI, United Rentals, largest renter of equipment in the world, another bullseye holding. GXO was spun out of XPO, and happy to say I own GXO for the same reason that I own Symbotic. I think logistics is a powerful theme. And I like owning themes because I don't have to reinvent the wheel every day. I can say, AI, powerful theme. Big cap tech, powerful theme. Computing power, powerful theme. Logistics, powerful theme. New mousetraps, powerful theme, right? We don't have to come in every day and say, geez, how are we going to make money today? No, it's what are the companies that leverage these powerful themes most effectively? And so that's a part of how I run the American Ingenuity portfolio.
So is AI then maybe the predominant theme within the fund?
No, it's not predominant, but it's big. I mean, computing power. So there are a couple ways we could think about artificial intelligence. We could think about the guys who are doing it. Microsoft is doing it. Google is doing it. Facebook is doing it. And then we can think about the guys who are facilitating it. NVIDIA's facilitating it. Practically every semiconductor company out there is, facilitating it. From Qualcomm to NXPI. Even the companies that, take Axcelis, for example, that makes the machines that embed silicon wafers with ions. They are facilitating computing power, and computing power, at least one aspect of it, is artificial intelligence. I think, Symbotic that we've talked about is a company that's then taking all that artificial intelligence capability and harnessing it, putting to work, as is GXO, through these robotic warehouses. So I think there are different ways to think about AI, from the companies that are doing it on the software side and using it to drive sales or awareness. Salesforce.com would be a great example, customer relationship management. Another bullseye holding, Palo Alto Networks, #1 for cybersecurity, and using AI to basically patrol networks internally for companies and externally across the cloud, using AI to improve their ability to ferret out bad actors. Those are other examples. So, every company, in the same way that every company had to become an e-commerce company sort of 15 to 20 years ago. And then every company had to become sort of a data analytics company. How do we use all this data? And then every company had to become a cloud company because it was more efficient to manipulate all that data in the cloud. Well, now every company's having to become an artificial intelligence company in one way or another. Target uses AI to figure out how to place mannequins around the store. I don't own Target, but I think it's pretty cool what they do to maximize sales. If we put an orange outfit on this mannequin in front of the escalator on Tuesday, how does that compare to sales of that orange outfit if we put it in front of an elevator on Thursday, or afternoon versus evening? Or, what if instead of a mannequin, we have a talking robot that, is speaking to kids as they, walk through a certain point of the store, right? I mean, Target uses all that data to try to figure out how to maximize foot traffic. Costco does the same thing, on the way to the new platinum bars that they're selling next to the gold bars, right? I mean, these companies are ingenious at constantly using data and scrubbing data based upon their own proprietary information to figure out how to sell us all more stuff. And so I think you have to respect that, but I think you also have to recognize that AI is kind of everywhere. And even if we can't necessarily identify AI pure plays, I think we can acknowledge the AI that's happening at all these companies and the opportunities for accelerated earnings growth that AI integration creates.
Yeah, I think it was just after ChatGPT came out that there was a lot of discussion about the future of AI. Everyone was really excited about it, and I think one of the takeaways at the time was that, well, maybe it's not necessarily a technology that produces companies that are themselves exceptional and create huge amounts of value, but it's more a productivity tool that every company becomes an AI company or uses AI, and from the efficiency gains, the margin improvements, that's how the market sort of gets lifted up on those productivity gains.
Yes. And it's very exciting. There's also a lot of talk right now about, robot took my job. Oh my gosh, AI is going to just eliminate all these jobs. Well, yeah, AI will definitely eliminate some jobs, but not all jobs. I read a story, it was in the Harvard Business Review, about how to sort of prove the point, they got 10 contract lawyers together and gave them all a bunch of contracts employment contracts to read. And on average, it took these very brainy lawyers, because it was performed by Harvard Business School, it took a lawyer on average something like 85 minutes to go through each contract and find the little things that they had embedded in these contracts that might trip up the lawyers. And sure enough, they found them, but it took them 85 minutes. They gave those same contracts to a program, an AI-powered program that had been effectively programmed to do the same thing, and it took something like 15 seconds on average. But, so does that mean you're going to get rid of all the lawyers? No. It means that you will first run all of these contracts through the program that will flag where there are issues, and then an actual lawyer will go through and look at everything that was flagged, right? And then maybe spot check everything else. I mean, might you only need 2 contract lawyers in your law firm where formerly you had 5 or 6? Okay, that's possible, but it's not like you're getting rid of all of the lawyers completely. So there'll be some adjustments.
That's too bad, by the way. That's a real shame. That's too bad. That's a real shame. We can't get rid of them.
Well, no, every now and then, it's like a broker. Every now and then you need a good lawyer or a good broker, so, yeah, let us be thankful for the moments when we, like an accountant. I don't want to do accounting, but I am very thankful that I have a very good accountant. And when I have a tough question, I call her, and it's like magic. She answers me and gives me, the right advice. So I'm respectful and thankful of experts and people who have expertise that I don't have.
Yeah. Well, you definitely just put the shine on that argument, because a lot of it is, largely boilerplate, and I think well worthy of some AI disruption in that context. If you can save yourself, 10 hours of, some high-priced lawyer reading a contract to maybe just one, that in itself is a huge value add.
Yeah. Well, think about something that we all probably use. At least I certainly do. When I'm writing for my investment letter, I compose in Pages, which is the Apple version of WordPerfect. The Microsoft, bulwark for writing text. And, it's pretty cool. I put on the spelling and grammar filter, and it highlights bad grammar or misspellings. I generally don't do autocorrect, because I want to actually go in and know that I misspelled it or mistyped it and fix it myself. And I don't always agree with the grammar that they insert instead of my own eloquent grammar. But still, it's just a good heads up. So that's a great example of AI that we're all using that we probably didn't even realize we're using.
Do you've been writing a newsletter and writing just more broadly for a long time? Do you find that there's always certain subjects that you can write about will get a lot more engagement than others?
So it's funny you ask the question, because people always comment when I write about oil and energy stocks. And they say, you always sound so passionate about it, and it's so compelling, and it makes me want to go buy these things. And it's funny because, oil stocks are really not what I focus on. Every now and then I do. I started my career trading oil. I actually started my career structuring mortgage-backed securities for Merrill Lynch, and soon thereafter, 2 years in, left to go trade oil, which was much more interesting. But the funny thing is, oil is not really a growth industry, and oil companies are price takers, whereas I would much rather buy price makers. A company that does something new and unique can determine its own price. Pricing power is a very compelling reason to buy a company. And if you're just an oil drilling company, you just have to take, the price that the market gives you. That said, what's interesting to me about oil companies is the sort of self-correcting mechanism that governs the oil market. When price goes down, there's less incentive for drillers to drill. When oil goes down to $50, all of a sudden they stop drilling. They shut in wells. And when they shut in wells, there's less oil being made. Well, when there's less oil being made, obviously less supply, price goes back up. And then vice versa, when oil goes to 100, every single well becomes very productive, and they're making money hand over fist. So they turn on the spigots. Well, When they turn on the spigots, they're producing more oil, and added supply pushes the price back down. So there's a self-correcting mechanism within the oil market whereby oil rarely goes below 60 and it rarely goes above 90. And if you look at the oil equities, they tend to trade in ranges as well. Now, there's some energy companies that are growing. Energy Transfer, largest operator of pipelines and handling equipment in this country and storage, they keep making acquisitions, so they, by definition, grow their earnings. But most oil companies are range trading companies. Again, as a growth investor, I'm not really buying them, but every now and then, like an EOG, you buy EOG under 100, you sell it above 140. They've got the best technology in the business, the best acreage in the business, the best balance sheet in the business, the best management in the business. So I always watch EOG. And when I write about these names, yeah, people sense that I get passionate and excited about it. Oil is just a cool business because it touches everyone in some way, in every way, actually, around the world. So yeah, oil is fun to talk about. Cool, growthy little companies like Joby Aviation are fun to talk about. Crypto used to be fun to talk about it until they all imploded. Now the only crypto I own is Coinbase because it's kind of my proxy and the last survivor. And I don't know if you guys know that Coinbase is the back office for BlackRock, largest money manager in the world. So any client of BlackRock that is trading crypto in one form or another is basically using the Coinbase back end. I think that's pretty cool. So it's my proxy again for crypto, and it's just easier to trade than Bitcoin. I've never owned Bitcoin. Yeah, oil's one thing I really do have a lot of fun talking about and people love. Stories about artificial intelligence people enjoy. I think people enjoy my conversations about logistics and my picks in logistics, which have made people some money as well, because I'm a tangible guy and I like tangible stuff. And robots, that's tangible stuff. Software, it's important, and I own a lot of software companies, but it's harder to be enthused about stuff that's intangible. We can make a lot of money in the intangibles, but it's just easier for me as a tangible guy to talk about companies using technology to improve their sort of bricks and mortar businesses.
Can we take a step back? In terms of implementation, how do you weight ingenuity? I mean, how do you figure out what should be your highest conviction weighting and what shouldn't be?
Oh yeah. So all the positions are weighted, at least initially, at 2 to 4% of capital at cost. So let's say we were going to start with $100,000 today and invest it. Each position would be between somewhere between $2,000 and $4,000 of capital, right? Because it's between 2 and 4%. We got $100,000 of capital to invest. Now, on day 2, those numbers move around. By day 62, they've moved around quite a bit because a lot of my names are volatile. In fact, I always tell clients, money management clients, I say, I don't want 100% of your wealth. I want the growth allocation of your wealth. So if you've got $1 million to invest and you're willing to commit 30% of your money to growth, then that would be $300,000. And then go put another $300,000 in dividend-paying stocks and bonds in there as well, and then have some cash on hand as well, because everybody sleeps better with a little cash. That's the way I run the portfolio: 2 to 4% of capital at cost. The risky little companies, we've mentioned Joby, get 2%. A big Nvidia, Meta, Google, etc., they get 4%. And then as they move around, they'll get bigger. Nvidia, I said, I've sold several times on its way up, and it's a 6% of capital at cost for most of the clients who've been with me now for several years. My hope is that some of these small companies, I had a biotech that went up 8-fold. We sold that. It was wonderful. And then we redeployed the capital. And the other thing about selling companies that hit your target, or selling a portion of a company that hits your target, is you suddenly now have more capital that you can go invest in, 1 or 2 or maybe 3 of the other ideas that have kind of surfaced over the past couple of months. And that's exciting. It keeps the portfolio flowing. Portfolio should be like a river where there's, constantly, new water coming in. If it's stagnant, it's a pond, and it just evaporates, and eventually you're left with mud. So you want flow in a portfolio.
I think we're wrapping up
Yep.
fairly soon here. Adam, for those who want to track more of your thoughts, more of your work, talk about those two sides of the business: the research, the money management, and where people can find you.
Oh yeah. Well, bullseyebrief.com is my investment letter that I launched back in 2016. I publish a new stock pick every week. Comes out at 7 a.m. Sunday morning, and I have a 45-day trial for $45. So it's a pretty easy way for people to dip their toe in, get to know my process, see the portfolio. And I tell what I'm doing every week: the buys, the sells, the news on our names, the catalysts, and again, as I say, a new stock pick. And then for money management clients, they can reach out to me directly. Just go to bullseyebrief.com, the investment letter, and you'll see a way to send me an email, and we can have a conversation about money management and what that looks like, and I can offer more details about how I run the portfolio.
Great. Well, seeing as this is the High Conviction podcast, what we often like to do is finish up with your sort of highest conviction idea. And it could be a stock, could be a theme, anything you want. But what is your highest conviction idea at the moment?
Yeah, I'm glad you didn't ask me for just one, because that's like asking a parent to name a favorite child, and that's not fair. So rather than name a single stock, I will tell you that artificial intelligence is absolutely my number one theme, and that touches so many companies. Microsoft would certainly be the logical way to play that amongst large cap tech. I mean, you could make the argument that Meta is too, but Microsoft, just because of what they're doing through OpenAI and ChatGPT, I think would be the obvious large cap name. NVIDIA would be the obvious semiconductor facilitator of artificial intelligence. And then, we start to get into all these other companies that are using artificial intelligence in so many different ways. And so even if it's not part of my artificial intelligence or computing power theme, and I should tell you, I own all the big cap techs. You have to. I call them core ingenuity, and they all are doing something in artificial intelligence. I own, as I've already told you, about 6 different semiconductors, all the big ones and the highest quality ones. And they're all obviously empowering artificial intelligence. I mean, just between those two themes in the portfolio, that's right now over 20% of my capital. It's actually about 25, about a quarter of the portfolio. So if you took no other takeaway, then Adam loves artificial intelligence and computing power. He thinks they're powerful. I should own large cap tech, and I should own a bunch of semiconductors. Fine, you're doing great. And then drilling down beyond that, go see bullseyebrief.com, and you'll get a quick and very in-depth education about how we leverage artificial intelligence across so many different sectors.
I think that's a good place to wrap this up. Phenomenal conversation with Adam Johnson. This, again, is the High Conviction podcast by GraniteShares. I'm Michael Guy, and my friend and primary host, Mr. Will Rhind, rocking it during this interview with Adam. And we will see you on the next episode. Thank you, Adam. Appreciate it.
Yeah, thank you, Adam. Cheers.
Great.